Okay, well, once more, welcome back to Intro to the Financial Services Industry. I'm Paul Judge. This section, we're going to start talking about funds and trusts. So this is part one of the section on funds and trusts. So just let's get into it. I just want to do my disclaimer again to say, look, this is for beginners. This is not meant to be a deep dive. If you're interested in a deep dive, go look for other resources. Everything we have here is publicly available, and I'm not making any financial advice or recommendations here on personal investing. So funds. So what's the idea of a fund? Well, the idea of a fund is for investors, rather than buy a particular stock or particular investment, particular asset, what you do is a fund manager creates a fund and purchases multiple assets, pulls them together, and shares of that fund are then marketed as an asset. So when you buy a fund, you're buying a share in that fund, and the fund holds multiple assets. That's basically the idea. And there's a number of different types of funds, but in each case, there's someone managing the fund. Now, the first one, which is the easiest one to understand, are index funds. An index fund is a pretty simple idea. The idea there is a fund manager goes out and says, okay, we're going to create a fund that mirrors a particular index and then buys stocks accordingly that will mirror that particular index. So when you purchase shares in that fund, if that index goes up, then you're going to see the performance of the fund should mirror that index. Then there's exchange traded funds. Now, these are funds that are actually traded and settle on a particular stock exchange. They trade and settle on exchange like equities. So this is a little bit of a weird situation where they trade intraday. So the price will change during the day, and they'll actually behave for settlement and trading like an equity, like an equity product. They'll trade on the exchange like any other product on the exchange. And there's advantages for that. We're going to get into detail. Then there's the one that we all talk about, which is mutual funds, where a fund manager comes out prospectus, comes out with it, publishes how he plans to he invests the money, raises money from various investors. Investors give the fund manager money. The fund manager creates the fund and sells it as a mutual fund. And everybody who pays into that fund gets a share, gets shares in the fund and shares in the growth and benefits of that fund. Then there's unit investment trusts, which we're going to talk about a little bit later. They operate a little bit similar to mutual funds, and we're going to get that in detail. And then there's closed-ended funds, which we're going to talk about also, where closed-ended funds basically where the fund corporation is created, a fund is created, and it raises money, but it doesn't raise more money later. It's close-ended, right? So let's talk about these in detail now. So index funds. So it's a type of mutual fund with a portfolio constructed to match or track components of a market index, such as the Standard & Poor's 500. It was an example we gave here. But there are index funds for lots of different indexes, for the transportation index, for the Dow Jones, for the Standard & Poor's S&P 500. Wherever there's a commonly accepted index used to measure the market in a particular industry, there'll be an index fund where a fund manager constructs the fund portfolio, which are the assets that are in the fund, will match the components of the index. Index funds, index funds are supposed to provide greater market exposure, lower operating expense, and lower portfolio turnover. The reason why they say it has a lower operating expense is the fund manager, the person managing this fund, isn't making investment decisions day to day. They aren't making decisions. They're going to just buy and hold proportional portfolio of assets that match the index. So if the index goes up, the fund makes money. If the index goes down, the fund loses money. But the fund manager isn't making decisions to buy other assets or sell other assets, to get out, to do things. The only decision that the fund manager is making is the fund manager is deciding to emulate the index. So whatever the index is, if the index is the Dow Jones Industrial, the fund manager is going to build assets to the portfolio that match the performance of the Dow. So they're not making decisions on a regular basis. Therefore, the operations expenses. So there are less expenses to index funds. Indexing is a passive form of fund management, this is kind of what I was just discussing. It's a very passive. They have been very successful. They have, in some cases, outperformed managed funds. But basically, when the indexes go up, S&P 500 is one of the ones that's very popular. Russell 2000, the Dow Jones Wilshire Fund. So there's a bunch of these funds out there, and they match these indexes. The primary advantages of this strategy is lower management expense ratio, right? The majority of mutual funds fail. It's been said that over time, the history seems to indicate that most managed mutual fund portfolios don't beat broad indexes. So the theory behind this is, if you're going to hold it over time the indexes seem to do better than individual managed funds. So you're just going to go with the indexes. That's the theory behind the index funds. And then, as we were talking before, about exchange traded funds. All right, the exchange traded funds are securities that track an index, a commodity, or a basket of assets like an index fund, but they trade like a stock on the exchange, right? So ETFs, right, exchange traded funds, they're going to be like index funds, or they're going to be baskets of assets, fixed baskets a basket is a fixed basket of different assets, right? And they're going to be very, very clearly defined, and they're going to trade on the market like a stock, like an equity. ETFs experience price changes throughout the day. So normally, like a mutual fund and other types of funds, you don't know the price of the fund until the end of the day when they calculate the NAV, or the net asset value. But in the case of ETFs, because ETFs trade all during the day, their price will fluctuate during the day as they're bought and sold, and they respond to the intraday price changes of the assets held in the fund. Because it's like a trade, like a stock, it does not have the net asset value calculated at the end of the day like mutual funds do. By owning an ETF, you get diversification of an index fund, as well as the ability to sell short, buy on margin, purchase as little as one share. Another advantage is that the expense ratios of most ETFs are lower than the average mutual funds, for the same reason we talked about earlier. When buying and selling ETFs, you have to pay the same commission to your broker that you'd pay for any other regular order on the exchange. So they are commission trades. one of the most widely known ETFs is called the SPDR, SPDR, which tracks the S&P 500 index and trades under the symbol SPY. So SPY is an ETF. It is a fund that mirrors the SPDR index, the S&P 500 index, and it trades intraday as an ETF, as if it was a stock. So effectively, in theory, when you buy the ETF for SPDR, you're buying the 500 stocks contained in the S&P 500, right? So with a very small investment, you get the diversification as if you're buying the whole S&P market, all 500 securities, right? So you're buying it proportionally as your share in the fund. So that would be the advantage why a investor might want to buy an index fund, and why they might want to buy an index fund that's traded as an ETF, because they get all the flexibility of a stock. They can short it, they can be long on it, they can margin it, they can sell it intraday, they can get all the liquidity available intraday for the market. All those advantages that you have from trading a stock, you would get it for a fund. So that's why ETFs have become hugely popular in recent years. So then there's mutual funds, which are the regular things. I think most of us know quite a bit of mutual funds. It's an investment vehicle that's made up of a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and other similar assets. So what happens is you hire a fund manager. The fund manager creates a mutual fund, collects a pool of funds from investors, and uses the money collected from those investors to buy various assets that fit the prospectus, the strategy of that fund. So, mutual funds may be a mix of stocks, U.S. stocks, foreign stocks, debt products, other assets, right? So the fund manager has a strategy, publishes a strategy, communicates to investors, hey, here's my strategy. Here's what I'm going to do. I'm going to buy bip-a-bop-a-boop. Here's what I'm going to buy, and here's what my strategy is for it. It's going to manage the fund. And all of the investors invest in this fund get a share of it. Mutual funds are operated by money managers who invest the fund's capital and attempt to produce capital gains and income for investors. Mutual fund portfolio is structured and maintained to match the investment objectives of the stated prospectus. So the fund manager produces a prospectus, which is his plan. Here's what he thinks. Here's how the fund manager thinks he's going to take your money and how he's going to invest it. But depending upon the prospectus, the fund manager might have quite a bit of latitude on how he actually executes that, and it can make decisions on an ongoing basis. You actually pay for a certain level of management, whether you're paying up front or on a fee base, or whether it's built into the back end. Generally, the fund manager is getting some sort of compensation for making the decisions. One of the main advantages of mutual funds is that they give small investors access to professionally managed, diverse portfolios of equities, bonds, and other securities, which would be quite difficult, if not impossible, to create on your own. So if you're a small investor and you've got $10,000 to invest, it's very difficult for you to have a very diverse portfolio that has stocks and bonds and foreign securities and other products in it, and to actively manage it day to day. But that same investor can take $10,000 and can buy into a fund, and that fund will provide that diversity and that management. So it's a very strong product for the retail investor. Each shareholder participates proportionally in the gain and loss of the fund. Mutual fund units or shares are issued and can be typically be purchased and redeemed as needed at the fund's current net asset value price, which is sometimes expressed as NAV-PS. So there is a level of liquidity, but like I say, the the NAV, the net asset value of the fund, and the value of each of your shares of the fund isn't calculated to the end of the day. So if this morning I want to buy into a particular mutual fund XYZ, I go and I say, I want to buy $100,000. Now I want to buy $10,000 of mutual fund XYZ. I don't know how many shares that's going to yield for me, because they say, okay, Paul, we're going to take your your $10,000 and buy into that fund. But then it isn't until the end of the night when they calculate the net asset value that they can come back and tell me exactly how many shares of the fund did $10,000 give me, right? So that's one of the things. These are also known as open-ended funds. They're open-ended because the fund manager will continue to take money in. You can always buy more. The fund manager will take more money. If you want, say the fund manager says, hey, look, you're being very successful. I want to buy more into your fund. Here's my money. Sell me more shares of your fund. You can always do that. So that's an open-ended fund where they will take more money. Now, closed-ended funds, we'll talk about in a minute, they don't take any more money. Once the fund is closed, they can't accept any more money. Okay, unit investment trusts, or UITs. This is an investment company that offers a fixed, unmanaged portfolio, generally of stocks and bonds, as redeemable units to the investor for a specific time period. It's designed to provide capital appreciation or dividend income. A unit investment trust are one of the three types of investment companies. The other two are mutual funds and closed-end funds. So it's one of those three types of investment companies that gets created. Okay, so each unit typically costs $1,000 and is sold to investors by brokers. This is where it gets interesting. These are actually sold by the broker, right? UITs can be resold on a secondary market. So the investor buys these, they buy them in increments for $1,000. They can sell them on a secondary market, and it's an unmanaged portfolio. It's a fixed unmanaged portfolio. UITs may be either a regulated investment corporation or a grantor trust. The former is a corporation in which investors are joint owners, and the latter grants investors proportional ownership of the UIT's underlying securities. So that's UITs. And there's closed-ended funds. I left this towards the end. A closed-ended fund is a publicly traded investment company which raises a fixed amount of capital through an initial public offering. So we talked about IPOs in an earlier session. So the investment company raises money through an IPO publicly. The fund is then structured, listed, and traded like a stock on a stock exchange, also known as a closed-ended investment or closed-ended mutual fund. Despite the name similarities, a closed-ended fund has little in common with a conventional mutual fund, which is technically known as an open-ended fund, right? So the former raises a prescribed amount of capital only once through an IPO by issuing a fixed number of shares, which are purchased by investors in a closed-ended fund as stock. So that's what closed-ended funds are. Unlike regular stocks, closed-ended funds represent an interest in a specialized portfolio of securities that is actively managed by an investment advisor and which typically concentrate on a specific industry, geography, market, or sector. So there might be a closed-ended funds that are, they focus on the transportation sector or the energy sector or the a particular geographic sector, geographic market, emerging markets in Latin America or East Europe or something, right? But it's a closed-ended company created with an IPO. They raise the money, they issue the IPO, they sell the stock in the fund, the shares, they sell the shares in the fund, and the fund goes out and is managed with that investment objectives. The stock prices of closed-ended funds fluctuate according to markets, supply and demand, as well as changing values in the securities and the funds that they hold. So that's a closed-ended fund. Now, there's a lot of similarity. We talked earlier about UITs and closed-ended funds, and there's just a real summary that says, although closed-ended funds or CEF, closed-ended funds, and unit investment trusts, UITs, have a lot in common in how they're structured, there's a few major differences. The assets held in a UIT are passively managed, while the assets in a closed-ended fund are actively managed. That, I think, is the biggest difference. In a UIT, it's passive management, right? There's nobody trading and buying and selling every day or in day or whatever. And the CEFs are actively managed. An investor cannot redeem shares directly from a closed-ended fund, while he can redeem shares directly from a UIT. UITs are limited duration. Closed-ended funds continue operation indefinitely. So closed-ended funds, UITs, have a duration. They end at a certain point. You get your money out, and then they kick off the next one, where CEFs continue indefinitely. So that's the difference between those two. The last type of fund I'm going to talk about here is called a REIT, a real estate investment trust. And REITs are an investment vehicle for real estate that is comparable to a mutual fund and allows both small and large investors to acquire ownership in real estate ventures. And let me get, properties such as apartment complexes, hospitals, retail buildings, warehouses, hotels, shopping malls. So what REITs do is REITs raise money, create a fund, and then what they'll do is they'll buy shopping malls, the real estate. You might have a REIT, I'm just making this up, but let's say you have a REIT that it buys shopping malls in Michigan, Missouri, New Jersey, Texas, and Pennsylvania. And it just buys those shopping malls. And it uses those shopping malls as investment vehicles, the real estate, to collect the rent, and it takes that rent and the money it makes from it, and it returns it as an investment income into the REIT that is returned to the investors. So, an investor may not want to be. You might like real estate, but not have enough money to buy an apartment building. But you can buy shares in a REIT that buys apartment buildings. For instance, there's one here that's very popular. It's a REIT that it buys and operates apartment buildings next to large universities, state universities that have student populations of 20 or 30,000 students. So what it does is, in different parts of the country, it buys apartment buildings and it collects the rental income from those apartment buildings. And since it's geographically dispersed, it provides a diversity for the investor. So there's lots of different examples of REITs, but basically they're real estate trusts that buy real estate and manage the real estate in some cases and returns the investment to the investment, the shareholder. REIT is a type of security investor in real estate through property or mortgages, and often trades on major stock exchanges like a stock. REITs provide investors with extremely liquid stake in real estate. That's one of the nice things about REITs is they're very liquid. You can sell them. You can buy them and sell them on the stock market. It is, the old story about real estate. You can always buy real estate. You can't always sell it. REITs receive special tax considerations and are typically offer high dividend yields. REITs have at least 100 shareholders, no 5 of whom can hold more than 50% of shares between them. At least 75% of all REITs assets must be invested in real estate, cash, or U.S. treasuries. REITs are required by law to maintain a dividend payout ratio of at least 90%. making them favorable in income-seeking investors. So if you're someone who's living on a fixed income and you want to buy investments that will produce income for you, yes, you could buy an apartment building and live off the rent, but it's a lot easier to buy REITs and diversify, manage your risk, and get that return. So that's part one of funds and trusts. If you have any questions, please contact me at the address listed below. And I hope to see you in our next video.